Tony, Tony Rice, he is going to guide us through the alternative finance panel. Oh, here you are. Thank you very much, Tony, for being with us. And if you...
I'm Tony Rice. I spent a lot of time here in the 90s working for a previous firm, so I know Greece very well. I'm a ship finance lawyer, although these days ship finance lawyers are doing completely different things than we used to do in the 90s and 2000s. I cover all sorts of areas of finance in the firm, but shipping is where I've always sort of had my sort of soul. Before I intro our four extremely experienced panelists, I think they have over more than a century of shipping experience between them. You're probably the junior one. I thought I'd just put in context very quickly the areas I hope they will address, and in particular what they will not address. So the topic we have is alternative finance for shipping. So that's alternative to what? Well, clearly to traditional bank finance, which we've just had covered by Jason's panel. But also these days, it's not really alternative. Capital markets are no longer alternative like they were years ago. We have bonds, IPOs, follow-ons in New York. We have bonds in Norway. That's all straightforward financing these days. And also, it's not really our sort of job today to discuss big-ticket ECA financing. That's happening for LNG, it's happening for cruise, but I'm not sure this particular audience is so interested in these areas. And nor are we going to cover things like JOLCOs, Japanese operating leases, or indeed French tax leases. These things are all happening right now. We've just done one in Singapore, our JOLCO. We're doing $1 billion of French tax leases right now to a container company in Paris. So they're all happening, but they are sort of special, bespoke areas where you have a degree of sort of eligibility to get into them, and they're not really what I would describe as alternative sources of typical finance for your average ship owner. We've heard today a lot about Chinese leasing, so I don't think we need to touch upon that. Capital markets, we have several sessions this afternoon which will cover that in detail as well, so I don't think we need to touch upon that. And after this panel, we have one on new bank entrants. So all the guys coming from Macquarie, CIT, Beal, M&M, etc. I think that'll be covered in the next panel. So that really leaves me to ask these four guys, what are they going to be supplying in terms of alternative finance? Their bios are all in the book that you have here. I was going to run through them for you, but in the interest of time, I think Nicholas would prefer that I didn't. So I think what I'd like to do really is, having explained what you're not going to talk about and what we won't address today, if perhaps you could each of us explain to the audience what alternative form of finance you are thinking about in terms of your own companies. And perhaps we could start at your end, George.
Thank you very much. So, YieldStreet is democratizing wealth management. People put their money, all of us, we have bank deposits and get almost zero for our money. We can buy bonds, get 2 or 3%, or you can put your money in the stock market, and good luck. So YieldStreet provides asset-backed opportunities to people to put some of their money into a product that will give them 9, 10, 11%, so that they have the opportunity to do what was only open to private equity in the past. We started in May of last year, and we've put out 140 million to date. Looks like the stage is coming down. So 140 million to date. Our first funding took about 4 weeks to sell. Our second funding was a revolver to a cash buyer. And so what we do, we have a warehouse of 100 million. We fund the project, we underwrite it. We then package it. We have a tech platform. We offer it to accredited investors in the US, and they have the opportunity to put in $10,000 or $20,000 and buy a piece of that funding. So the $25 million revolver that we broke into 2 offerings, and I'm going to show you a video. On the left, you will see how much is left of the opportunity, and on the right, you're going to see the time lapse. And Dimitri, just stick it on if you will. Thanks. So it sold in 18 minutes and 50 seconds. The second tranche sold in 12 minutes. And our more recent offerings sell in a few seconds. So that tells us that the public at large have a desire and a need to be able to put their money into something that will earn them a better return. And so that's what we do. And I'm open to questions, and I would also be open to questions at the end from the audience, because I'm sure there's a ton.
George, what kind of ticket size are we talking about?
So we do nothing under 10 million, and to date we've funded up to 30 million.
And the gearing, loan to value?
So loan to value around 70-75%. The cost to the borrower is all in 12%. We offer our investors, as I said, 9.5, 10. We try, our objective is to give people the opportunity to earn more on their money. So hence the democratization of.
Okay, so you're working in a very sort of specialised end of the market, really, because in terms of volumes, you can't compete, of course, with capital markets who last year put sort of 16 billion into the industry, or Chinese leasing we heard this morning with many more billions. It's a very specialised niche area.
It is, and if you call 600 million assets under management in 3 years niche, yes, it is.
Yeah.
We hope to, by the end of this year, have the whole platform up to 1.5 billion. And it's growing. We have an investor base of 100,000 investors, growing at 5,000 a month. Mm-hmm. So our objective is to scale and not stay niche.
And are there any parameters around vessel age or type?
So because we're asset-backed and we like to protect the principal for our investors, we do something banks don't do and go for older vessels. We like we do our scrap to cash buyers. We like to invest in vessels that are 15, 16, 17 years old and can be employed to the end of their lives and amortize them down to below scrap, so that the objective is to get the money back. We've done a few RVIs. We were the first platform to where the borrower negotiated an RVI, so we lent against that. We find situational funding where an owner wants to buy his loan back or the ships back from a bank and can get, and we can provide the bridge for that. Our cash is pretty quick, so that's attractive. And we find that short-term lending is more attractive on the platform, so we have devised shorter-term products that appeal to some situational funding that people would like to do, that ship owners would like to do. So we don't compete with banks. We special situation funding.
Okay. Mark, what's your offering?
Sure. So this is under the banner of, Ascension Finance. This is our first sort of public outing or launch of the brand of Ascension Finance, which is a new lending company set up by the principals of RMK Maritime. RMK Maritime is a company that was established in 2012 as a maritime financial advisory company with an office in New York and London. The New York office is an investment bank. The London office concentrate on more commercial debt and leasing solutions. Over the years, my background is shipping banking for the last 30 years. I left my last bank 5 years ago when that particular bank wound its portfolio down and chose to exit along with a lot of other banks, and joined friends and colleagues at RMK with a view of looking at this huge gap in the market for small and medium-sized shipping companies that the banks don't love anymore. It's taken us some time to get the model right through a number of iterations, and also to find the right financial partners. It's not our balance sheet. We have funding partners with committed capital of $300 million. We effectively set up in business in Q4 of last year. We're writing our first transactions right now. We're looking to grow on all of that. And Ascension Finance has been set up specifically as an affiliated but separate entity to the RMK brand, which looks at much more sort of complex financial solutions across the capital spectrum.
So it's a new fund.
It's
300 million
a
fund
new lending company with
Yeah.
investor fund backing. So actually, it's not, in my view, it's not alternative financing. What we're looking to provide actually is fairly traditional financing terms, but the source of those funding is alternative to what it used to be from the traditional banks.
And could I ask you what you'd expect to be pricing on that for?
Our objective is to have, once we've deployed all of our capital, and in terms of ticket sizes, similar to George, $10 to $25 million approximately, so that we can build a portfolio with $300 million with a reasonable amount of diversification of assets and borrowers. We're targeting an average margin on the whole portfolio of around 6.5%. So that's our aim. Realistically, we are going to be in the 6 to 7% range, and our LTVs up to 65%.
So like many of the sort of people here today and others in the market, the new banks coming along and new entrants, you're looking to capture that sort of ship owner who's not quite Champions League, to whom all the banks are lending, but is top quality sort of Premiership, top of the league, but just can't get into the big banks for whatever reason.
Yeah, exactly. To give specific examples about what we're looking at, we are transacting with a small owner here in the dry bulk sector who's got 2 debt-free ships and he's looking to buy a third. He's banked with local banks, but he's not really a core client for them anymore. Suits us very well. That's at about 50-55% LTV, and then the other end of the spectrum for us anyway, we're talking to a significant Turkish owner who's had very good banking relationships with some of the bigger banks that have pulled back. He's no longer a core client. He's had a 10-year loan with that particular bank that comes up this year. He bought the ships as new buildings, fully performed. The balloon's coming up for refinance, and the bank says, well, you're no longer a core client. And he's not had the benefit of wider banking relationships. Like a lot of ship owners, he relied on his long-standing relationship banks, and they're no longer there. So now he's finding himself having to sort of scurry around trying to find alternatives. It's somebody that I knew in the past, so we get on well, and it's worked very well for us to offer him an alternative. He's not going to get the pricing that he's used to, but the world's moved on.
And is your company sort of agnostic to vessel types and geographies?
It's asset finance, so we're looking specifically at the ships themselves. Further recourse to personal guarantees or corporate guarantees is a nice to have, but we're not reliant on that. So we're looking at the ships and the cash flow, and as a result of that, we're aiming at those mainstream asset types where there is more liquidity and ability to assess the future values and also the historic values and also the cash flows.
Okay, thanks. Okay, Svein. Could you explain a bit about what you're currently doing?
Sure. Well, first of all, I want to start off by thanking all of you for sticking around this Friday afternoon. It's really quite impressive. EnTrustPermal is a roughly $20 billion asset manager headquartered in New York. I joined the company, the firm, back at the end of 2015 to build a new lending platform focused on the maritime industries. And that's what we've been doing, quietly building over these 3+ years. We are now raising our third fund. We have, up to this point, we have roughly $800 million, $830 million of capital commitments, of which we have invested roughly $560 million, and we have another $200 million that we're documenting right now. So when we raise our third fund, which we're targeting for the end of Q2, we expect to get to somewhere between $1.3 and $1.5 billion of total commitments to the strategy. So what we're doing is really, excuse me, filling the gap, like our other speakers are talking about, where the banks really aren't as active as they used to be. Initially, we thought that we were basically only going to focus on these companies that don't really have a lot of alternatives, alternative bank debt capital today. But we've actually found that we're doing a lot of additional business with companies that we've been banking with in the past. We have a team of ex-bankers within EnTrustPermal. This is all we're doing. And we found that the execution of what we're doing is actually gaining us a lot of business that we didn't expect. We're very efficient, we're very predictable. We are expensive, or more expensive than the banks for sure, but we try to compensate by being very, very good on execution. We are also going further than the banks are. We obviously know that in order to earn high returns, we have to do more. So typically our deals are in the 60 to 80% loan to value range. And we also try to structure the amortization profiles and so on to work in whatever market environment we're in. We are very kind of cyclical. We are focusing on the sectors that are closer to the bottom than the peak. It's very good today because, as you know, most sectors are closer to the bottom. So we are quite busy. So that's the background of the Blue Ocean Fund.
And you mentioned what's the sort of lending capacity that you have within that fund? Is it significant if you had some large transactions come through?
Yeah, so one thing is what we can do in the fund itself. We obviously have certain parameters in terms of exposures and so on. We don't want to have half the fund to one company, but being part of a much larger asset manager, we have the ability to bring in co-investors. We're less likely to go out to other lenders, other funds or other banks to fill in the rest, but we do that in-house. We have about 700 institutional investors within EnTrustPermal, so we have done several transactions that are too large for the fund on its own, so we bring in some of those co-investors, typically public pension plans, insurance companies, and so on. So we don't really have a limit on the upside in terms of size we can do. We tend to focus on transactions $15 million and above, and as I said, it can be $700 million if the deal makes sense.
So without wishing to put you all on the spot too much with the same questions, would your answers to pricing, gearing, loan to value, vessel sort of ages and loan tenors, that will be the same, would it, as we've heard from Mark and George? Be very similar stuff? Well,
I mean, every deal is different. I mean, we look at what the fund returns, not on a per deal basis. So we don't only do senior secured lending. We also do some junior. We've done some preferred equity. So what we're looking for is what the total fund throws off in terms of returns. And so we have some deals that are returning very, very high in numbers, and others are still decent, but obviously not as high as some of the other ones. So it really depends on the company, the type of product, whether we talk about senior secured or junior or preferred. Junior loans, preferred equity, we're targeting sort of mid-teens, and senior secured debt obviously lower than that.
So you're open to do mezzanine?
Yes. We have a very, very broad mandate. Should also mention that in addition to shipping, we also have a mandate to do offshore oil services. We haven't focused too much on that yet, but we have started to dip our toes in there, and we recently closed one transaction in the offshore oil services sector as well.
Okay, thanks. Elias. Right, please tell us what Australis are doing.
Thank you. So, Australis Maritime is an asset management business which is focusing on extending credit on a primary basis. So we don't buy loan books. We extend credit on a primary basis to the shipping and the offshore industries. We do that both in mortgage lending form, but also in the form of sale and leasebacks. And the way we think about our business, instead of defining it in terms of the addressable market from an ownership perspective, we think about it more in terms of the types of projects that we focus on. And what I mean by that is we focus on projects where there is a need for flexibility from a structural perspective. Most people would think about high LTV, but that's not all. We've done deals down to 50 or 55% LTV because of other structural elements that banks would not be able to do. But we indeed go deep into the capital structure and can go up to 80%. Secondly, we financed almost any asset class in shipping and offshore, including older vessels. So we have a lot of flexibility from an age perspective as well. And finally, a lot of the opportunities that cross our desk, which are very, very interesting, also have an element of time pressure. One of the things that we can do because of our setup, and I'm sure that a lot of the other people on this panel can say as well, is that we can move extremely quickly. And we have underwritten a $200 million transaction in 3 days, which is something that cannot easily be done elsewhere. From a setup perspective, we have committed capital. There's no financing out in any of our documents. And we can also look at a variety of sizes. We do single vessel financings, and we've done them, and we're very happy with them. And we can also do quite large transactions over 100 million.
And this is from New York or London?
We are based in London.
London. Okay,
Yeah.
so all your stuff's under English law.
That's right.
And you
Actually, no. We
No,
can
either.
do English law documents. You can do Norwegian law documents. You can do Singaporean law documents. You can do
whatever's appropriate.
Yeah.
And ticket size, you say, seems to be
From 5 to over 100. Yeah.
Okay. Now, one question I wanted to ask to all of you is that obviously people in this audience, including myself, have seen many entrants come and go in shipping over the last 20 years or so. So, owners themselves will not want to get into bed with a lender who changes their mind sort of halfway through the tenor of the loan in terms of shipping as an attractive industry. So what could you say about your sort of commitment to shipping industry? Perhaps we could start with you and go backwards.
Sure.
Resilience.
All we do is shipping. We have been set up as an asset management business, which is focusing only on one industry, and that is shipping and offshore. And that's what we'll continue to do.
Okay. So it's not sort of a closed fund type of arrangement. So if you get certain numbers, you're going to stop, or as long as there's business, you'll do it.
Well, first of all, our funds are quite long. They can go up to 10 years. As long as there is demand for capital, and I think the main risk to our strategy is that regulations, particularly in Europe, will start to reverse. We don't see that happening anytime soon, and the banks then pile back into the market the way they used to in the past. That ultimately is a risk to our strategy, but we don't think that is a major risk. We're in this for the long term. As I said, we're already raising our third fund, and we're going to continue to do this as long as there is demand for the capital.
Okay. And you can move quickly as well in the way that Elias explains?
Well, we are done underwriting in 2 days. No, we're very, very efficient, and as I mentioned earlier, this is one of the reasons why we are getting a lot of interesting business with former clients from the banking days, because we can turn around quickly, not just to get the underwriting done, but also to get all of the documentation and funding done. Sometimes, obviously, the lawyers will slow things down, but we can certainly be very, very quick.
That always happens. Mark, I know you yourself have been long-term committed to industry for Berliner Bank, RBS, Santander, Alliance and Leicester.
Don't know what else to
RMK.
do. I've got nowhere else to go.
So you personally, I know, are focused entirely on shipping, but what do you think is the story with Ascension?
Looking at things from a ship owner's perspective is important, and it's easy for us and any sort of new lender, whether it's a bank or a fund or whoever it might be, to come to ship owners and say, hey guys, we're going to lend you some money, isn't this great? But that due diligence and building a relationship, it's a two-way thing. And one of the things that we've seen, is ship owners specifically asking those questions and pushing us hard. Who are you? Who are your partners? And where are you going to be in all of this next year? And what if the market comes off? Are you going to take my ship away at the drop of a hat? And we have to work hard to explain our personal backgrounds, and we've all been around in our company in shipping for a long time, in shipping finance, and really trade off of our long-term relationships and experiences in hopefully getting ship owners comfortable that we mean what we say and that we are going to be around, and our financial backers are taking our advice on how to build the portfolio, but then once we've built the portfolio, how to manage it and how to run it. And we've been very open with them that we're not going to just write these loans and put the loan agreements in the drawer. There may be times when we have to revisit things and covenants will get tight, and there may be a need for repayment holidays. And they get that. And one of the things we've found in terms of actually the timing to write deals, we can get there quickly, but the owner's got to do his work on us too, and that means not just doing it over the phone or on a conference call. It's being in front of the owner, seeing him coming to see us, and building that relationship. And I think that's a critical part of it. If we don't have that relationship, then if it does get difficult, then it becomes twice as difficult as it might otherwise be.
Okay. And George, YieldStreet's here to stay. It's a long-term investment and for you and your partners.
So, we opened up an office in Athens. We hired Stefanos Fragos from DVB. He's here, 16 years with DVB. We hired Chris Goutsoyanis, ex-RBS. So we're setting up a team to interact with ship owners. Fundamentally, the ship owner has to make money. So when we go to a transaction, we like to understand where the money is. And if the ship owner can make money, he can then service our debt, and everybody can be happy with the transaction. We are short-term, so if the shipping deal itself doesn't make money, sometimes there's a trade that the ship's going to do. We try and find some help from the trade, because at the end of the day, we want to get out, and he wants to be left with the ship and own the ship debt-free. So we have the flexibility to structure transactions for the benefit of both. And we don't have to lay out money. We look for transactions that make sense for our investors and make sense for the ship owner, and then we go about making it work.
Okay. Now, I think finding the money, the source of funds for probably all of you has been the original major objective. Yours, of course, is...
Yes, I'll start.
Well, let me just... No, you've got that in hand. But I was going to ask you, having sort of got that major problem out of the way, principally, what are the main problems that you've encountered in getting these new startups going? Has it been regulatory? Has it been legal? What's been the issues that have sort of challenged you the most, or will challenge you, in getting deals done?
So, YieldStreet is a fintech company. And banks have the customers. But banks, the banking system is fundamentally broken. They don't give you anything for your money, and yet they talk of cost of capital. So what is cost of capital? Cost of capital is thousands of people sitting in offices in High Street, huge rent, Executive bonuses, Armani suits. So that's one cost. YieldStreet has technology, and once you sign on, there is no human intervention. The technology will pay your interest to you, to your bank account. You'll get your tax forms. So there's a zero cost. The cost of acquiring a client is extremely low because we use social media so we can grow our platform. I think the question becomes, will banks learn to use technology before fintech learns to scale? And the race is on. So let's have fun.
So you'll be hiding from the bankers when you leave the panel today, will you?
Not at all.
Yeah. Elias, what kind of risks have you faced, problems, challenges in getting your platform going?
Look, I think the most important thing is to make sure that you can deliver what you say you can. And the underwriting process is obviously the beginning, but then you need to be able to execute and to be able to execute fast. And that means going from term sheet to funding as quickly as possible. Obviously, what we've done is we've developed standard documents both for loans and for leases. So a lot of the suspense is taken out of that process. We've set up a whole cash and account management system, so new assets can be slotted into the portfolio very, very efficiently. And we've also set up a very, very sophisticated monitoring system to make sure that works on an ongoing basis. And these, in many respects, and it's a very good question, and these, in many respects, are significant hurdles. There have been many such platforms that have been launched over the last 3, 4, 5 years, and some of them have been tremendously successful, and some of them haven't. And the primary reasons that the latter have not succeeded is not because they didn't have the capital, but they couldn't execute. And this is probably priority number one for everybody here.
Yeah, I agree, because credibility is key. And if you can't execute, you lose credibility and people won't want to work. Svein, what would you say about that?
Yeah, so obviously, fundraising, as a lot of you know, is not easy. I'm not gonna sit here and tell you it's not been a grind to especially raise the first fund. It took us 18 months to get the first fund going, and I was obviously helped by being part of a large asset management firm with their own salespeople and so on. But still, it's challenging. And especially when you don't have a real track record. Even though I've been in banking for 30 years, it doesn't really count when you're talking about track record with the investors. You have to show track record in fund setting. So we're now well into our third year, and when we now go back out on the road, it's a huge difference from the first time. So the important thing for us, though, in setting this up is the discretion that we have in terms of how we do the business. We have a very broad investor base. We don't answer to anyone but ourselves. Obviously, we do have an investment committee, but we have a very, very simple decision process. I chair that committee, which obviously helps. But the most important thing is that when you talk to us, the fund, you really just deal with the team, because we make all the decisions. If there are any issues, any amendments, covenant issues, you only deal with us. We don't have to go to any kind of board or anything like that for approvals to make changes. Same thing with the underwriting process. If we say we're going to do something, we do deliver. So this discretion and the way it's set up is absolutely key. Yes, that's really it.
Okay, thanks. And last but not least, Mark.
All of those.
Same.
I mean, the initial challenge for us in the last 3 or 4 years has been securing the funding, and we've been close. We've been left at the altar a few times by guys that said they loved it, and then within a matter of months, or in one particular case, nearly a year, they just turned around at the end and said, "Yeah, you know what? We're going to do something else," and that was the end of that. Having got to the point of secured the funding, it's then how are we going to deploy that? And it goes back to that point about reputation. You know, we could have chosen to do it with the RMK brand because that's got a, you know, it's got a good reputation and it's relatively well known. Ascension is new, but we chose to make that distinction, and so we've got to, you know, sell that company and build its reputation, and that's a challenge for us. The infrastructure and the support is critical, and you know, we've all worked in banks and come from that environment where that's the luxury of, you know, a middle office that does all that stuff for you. You don't have to think about it. But we're creating that from scratch. And yeah, I mean, and if you get that wrong, and even if the loan's performing, then it's a mess. So every step of the process in starting something like this is a challenge. And then last, one of the biggest challenges can be not to rush in and finance every deal that comes through the door or with the first person that you meet. And you know, you want to get that money deployed because you've got pressure from your funding partners, but you want to get that money back as well. So you know, we like I'm sure my peers here will be turning down a lot of business that you think, well, you know, should we do that? Yeah, it just about fits, but you know, you have to be very disciplined, and that's one of the biggest challenges in the early days of something like this, is having that discipline, because if you don't have that, then you're out of the game very quickly.
Okay. Well, having indulged you all in such appalling self-promotion, I would have liked the audience to hit you with really difficult questions, but we're out of time, I think, Nicholas, and I'm not being permitted. So I'm sure there have been some nice, less nice questions from our audience. Otherwise, there is a question. Are we allowed questions? Are we allowed questions or not? We're not allowed questions, so you're off the hook, guys.
Thank you very much.
Thank you very much to the panelists.
Thanks, Danny.